Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Wednesday, everybody. It is time that we discuss the current state of equity markets in China once again. The situation remains, frankly, terrible, but as we will see, some investors are seeing stirring potential. Regular viewers know the story up to this point, of course. As of the end of the Lunar New Year holidays, some $6.5 trillion, tens of trillion of yuan worth of market value has been wiped out from mainland Chinese and Hong Kong stocks from the 2021 peak. Incredibly, Hong Kong stocks are now back to the levels of the 1997 UK PRC handover. This all powerfully underscores the challenge that Beijing faces as it seeks to arrest a decline in investor confidence. Foreign investors have been aggressively selling China's onshore equities in the new year. Global funds offloaded 14.5 billion yuan, $2 billion worth of shares on a net basis in January via trading links with Hong Kong, extending their selling to a record 6th month. In a statement after a series of seminars with retail and institutional investors, listed companies and foreign institutions held over the past 2 days, today, the China Securities Regulatory Commission, led by its new chairman, the previous was sacked due to the poor performance of the markets, said that it will treat opinions, suggestions, and even criticism from all parties seriously and implement the feasible ones immediately. The statement read, quote, "The capital market has wide implications, and the more complex and severe the situation is, the more open we should be to heed advice and pool wisdom." End quote. Beijing leadership has piled blame on the securities regulator for the trillions in losses in recent months. Meanwhile, China's mutual funds produced a mixed bag of performance last year. Publicly offered equity funds endured a second straight year of losses. Bond funds, on the other hand, had a, quote, "comparatively stellar year," end quote, in the words of Chinese financial media outlet Caixin. The outlet explains in a report published today that the uptick in bond fund flows fueled a shift in China's asset management landscape. Quote, "With mutual funds emerging as the most preferred asset management avenue, outstripping banking wealth management for the first time, this shift reflects investors' concerted efforts to navigate prevailing financial market volatility and mitigate risk in the country's stock market," end quote. The median rate of return for equity mutual funds was roughly negative 16.5% last year. Around 95% of funds reported negative returns, with a majority posting a loss of more than 10%. In contrast, Caixin reports, bond funds and mutual funds under the Qualified Domestic Institutional Investor QDII program, which acts as a conduit for local capital investing offshore, reported positive return rates of 2.9% and 3.1% in the past year. The big question in recent months has been, when will the bottom come, and are Chinese stocks now to be considered cheap? On the latter question, some well-known contrarian voices think in some sectors the answer is yes. Michael Burry, of The Big Short fame, has bet on Chinese technology giants Alibaba Group Holdings Limited and JD.com Inc. in recent months, with his investment company boosting its stake in Alibaba by 50% in the period ended 31st of December, according to the firm's most recent 13F filing. US outlet Bloomberg observed on the news, quote, "While the stake was only $5.81 million, it's a starkly contrarian bet on China's largest online retailer. Smaller rival JD.com Inc. was the company's second biggest holding at $5.79 million, after the firm increased its position by 75,000 shares." End quote. So far, the bet hasn't been doing very well, however, with Alibaba down 3% year-on-year and JD.com down 15%. Burry will be hoping for a strong recovery and growth in the medium to long term.
If you're enjoying today's episode of China Update, don't forget to hit the like button. Liking, sharing, and subscribing all helps for the channel. And for anyone who can go that extra mile and help me keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. This is a lot of work, but all your support are all incredible sources of motivation. So thank you so much, everybody, for the ongoing support.
And finally, on this first story and blending into a new story, US-based OpenAI unveiling of its text-to-video model Sora has sparked a frenzy of sorts in the People's Republic of China, with stock buying and public commentaries. China-based financial media outlet East Money writes today, quote, "On February the 20th, as the popularity of Sora continues to soar, stocks in the newly born Sora concept sector in the A-share market have continued to surge. By the close of trading, the sector had risen by 4.07%, significantly outperforming the Shanghai Composite Index and the Shenzhen Composite Index, which only increased by 0.42% and 0.04% respectively. Stocks for many companies in this sector even hit their daily limit, with many achieving a 2-day winning streak." End quote. Interestingly, even state media has had to admit that China is falling behind the United States in the AI race. State-run The Global Times, in a very telling article, expressed today, quote, "Why do technologically innovative products like ChatGPT and Sora happen in the US instead of China? Is China being put into a passive position in the development of AI? The Chinese public is increasingly concerned. China's generative AI models are obviously falling behind those of the US. The emergence of Sora is seen as adding new pressure on Chinese companies. We must acknowledge this gap, but it should not lead to a loss of confidence. Instead, it should inspire determination and courage to catch up." End quote. Next up, and finally for today, UK-based The Financial Times reports this week that China's state-owned enterprises have begun setting up in-house reserve military units, a legacy of the Mao era, quote, "in a sign of authorities' increasing concern about social and political instability amid the country's economic slowdown," end quote. The Financial Times analysis of company announcements and state media reports over 2023 shows that dozens of Chinese state-owned enterprises have established so-called People's Armed Forces departments in recent months. The departments, the outlet explains, were historically groups affiliated with the People's Liberation Army's recruitment efforts at the country and village level under Mao, and also used for militia-like activity. Today, quote, "they typically conduct civil defense activities and contribute to military recruitment, promotion and training," end quote. China analysts were quick to point out with the news that in October last year, a Ministry of Defense spokesperson speaking to media expressed, quote, "China's national defense is the responsibility of all Chinese people. The militia system is a traditional, basic military institution in China, and the People's Armed Forces Department in state-owned enterprises constitutes a part of China's national defense system. In recent years, the People's Armed Forces departments in these state-owned enterprises have played a critical role in enhancing national defense mobilization and reserve force development." End quote. It is unclear whether this increase in militarization or militia presence within large state-owned enterprises is focused on domestic disquietude or on external ambitions. As such, we must continue to follow developments in this space closely. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Wednesday, and I will see you all tomorrow.